Most investors are flummoxed given the prevailing uncertainty. The question uppermost in their minds is, where should I put my money to create long-term wealth? One option is diversification or investing in different asset classes. And to talk to us about investing in multi-asset classes, we speak to Nadir Tokan, investment analyst from 24/7. Thanks very much for your time.
Sure.
Nadir, where should we be putting our money right now?
Yeah, I mean, so I think at the moment, so we punt multi-asset class funds. We always say that in finance, the only free lunch you get is diversification, so we'll stick by that. So multi-asset class funds, but at the end of the day, you ultimately want to be in a multi-asset class fund which has a bias towards equities. And the reason for that is that over the long term, equities are poised to outperform all other asset classes. They're a little bit more volatile over the shorter term, but over the long term, obviously equities are poised to outperform. And we think at 27.4, ultimately the best opportunities lie in offshore equity markets at the moment. I mean, they're coming off a low base. Well, they've done quite a bit this year, but if you're looking back all the way to 2000, at the beginning of this year, they'd gone practically nowhere in some 12 years. So they're coming off a low base. We see those companies starting to grow their earnings nicely. We see pools of liquidity both in the euro, both in all developed markets, Japan, be it Europe or be it America. Pools of liquidity are really forcing investors to move up the risk spectrum and look towards equities. So yeah, quite bullish on the developed market equities, but with local equities as well. Don't completely discount them. They've done quite a bit. I think there's going to be a rotation away from the defensives into the more cyclicals. We've already seen it coming. So yeah, I mean, over the long term, you want to be in a multi-asset class fund, but with a bias towards equities, because that's what's poised to deliver the best performance.
Nadir, we've got the 27.4 CPI plus 3% fund that we were interested in, and you obviously have the ability to scale up and scale down the equity component. Just take us through in terms of achieving a CPI plus 3%, which is roughly a 9% per annum return. How significantly have you varied the equity component in that fund over the last few years?
So we look at, well, for all these portfolios, we have what you'd call a strategic long-term asset allocation. That's the asset allocation which we believe over the long term will be poised to deliver the target return, which is CPI plus 3%. You're looking at somewhere around 28% in local equities, with a further 10% or so in offshore equities to deliver that. What we tend to do is that we say that you allow yourself a 5% lower or higher band around that, depending on what your views on the market are. So obviously at the moment, fixed interest markets are not looking attractive at all. We all know what the bond market in South Africa, what kind of pressure it's coming under given our current account deficit. We all know what pressure the offshore fixed income markets are coming under, with an eventual tapering of quantitative easing likely to come through, and also with the federal funds rate nowhere to go but up, both in the US and the same in the Eurozone and Japan and the rest of Asia. So pretty bearish on fixed interest markets. So at the moment, we pretty much as bullish on equities as we could be in this fund. And as I said, you know, we pay in a band of either 5% underweight our long-term strategic asset allocation or 5% overweight.
You mentioned some of the names. So you've favoured investing in the offshore equity space. Can you give us some names around what's some of the companies you've been buying overseas?
Okay, so we are multi-manager, so we don't buy companies directly. We invest in other funds. So to give you a typical example of some of the funds we've liked over the last while, I mean, we talk about the recovery in the developed markets, but we still think that it's a very delicate recovery. So we see one bad number coming out of the US and all of a sudden markets are faltering, and the next day we see one good number coming out and markets are booming. So it's been a little bit of a fragile recovery. It's been very, very susceptible to what data is coming out. So we've preferred to play the offshore space with a more defensive global brand type companies which are cash flush, paying good dividends, have good emerging market consumer penetration, but are listed in the developed market. So they have the governance of an S&P 500 company, but they're developing a large proportion of their revenue from the emerging market consumer. So companies such as Unilever comes to mind, Microsoft, some of the major tobacco brands, Japan Tobacco, Philip Morris, some Anheuser-Busch, the brewery.
So you're still very enthusiastic about the emerging market story?
Enthusiastic about the emerging market consumer, yes. The emerging market financial markets, unfortunately at the moment what we see is that they're still really susceptible to the global flow of capital. So if Ben Bernanke had to, well, it looks unlikely now, but for argument's sake, if you had to taper quantitative easing at the next Federal Reserve meeting, there'd be a drain of liquidity away from emerging markets towards developed markets, and regardless of what you think of those emerging economies, their financial markets, their stock markets, their bond markets will suffer with a when global capital leaves those markets. So bullish on the emerging market growth story, but more bullish on the developed market equities, which can tap into that growth story.
Nadia, we had a fascinating interview done by our Squawk Box team in the US with Stanley Druckenmiller, who was obviously partner with George Soros on the end of tapering, and what he considers the risks now in the fact that the Federal Reserve is going to continue to provide liquidity into the market and some of the unintended consequences that might flow from that. Is that registering all on the minds of your fund managers at the moment about some of these risks that may be building up because the Fed is continuing to offload about $85 billion a month into the purchase of US government treasuries?
Yeah, I mean, it is a factor they consider. So obviously when you're pumping the equivalent of half the entire South African bond market into financial markets every single month, you've got to consider what are the long-term consequences of that. But we've got to remember that subsequent to the financial crisis, all developed markets were exceptionally weak. And Ben Bernanke, being a scholar of the Great Depression, really understood what the dire consequences are of a drying up of liquidity. I mean, to give you an anecdotal example, Jeffrey Immelt, the CEO of General Electric, called Ben Bernanke up at the height of the crisis and said, I can't roll over my short-term debt. Without me being able to roll over my short-term debt, my business is going to cease to operate, and that's a company that's at a $245 billion market cap. That's a third the market cap of the entire JSE, which would have essentially ceased operations had liquidity dried up. So, I mean, that was an extreme tail risk that the Federal Reserve had to deal with. They still believe they're not completely out of the woods, and one would tend to agree. We see unemployment on a downward trend, but that's really due to labor market participation falling rather than the actual creation of jobs at a rapid rate. We're seeing inflation remaining particularly subdued, well below the 2% target. So at the moment, I think we're still a considerable way away from worrying about the tail risks of too much liquidity in the market. The Federal Reserve is trying to ensure that markets can stand on their own 2 feet, ensure that markets are well into their recovery. The housing markets are not at risk of a massive sell-off should interest rates spike. And so I think that's the biggest concern for the Federal Reserve now, rather than the risk of pools of liquidity in the market.
Thanks so much, Nadia. That was Nadia Tokan, investment analyst from 27/4. That's it for Investment 360.